Stocks jumping ahead of the closing bell. The S&P 500 is closing in on an all-time high here as oil prices slide again. For more on the latest moves as the tentative ceasefire in the Middle East has sparked a rally in risk assets, let's welcome in Michael Arone, Chief Investment Strategist at State Street Global Advisors, which has over $4.5 trillion in assets under management. Michael, it is good to see you. So let's talk about these markets. Grinding higher, Michael. The NASDAQ 100 set for a record here. It wasn't too long ago. It was early April. It was Liberation Day. The sky felt it like it was falling, Michael. Run for your bunkers. Why have we kept grinding higher here off those lows, Michael? I mean, is it first and foremost because Trump backed off that maximalist position on tariffs? Is that what we chalk it up to?
I'm not sure if it's entirely that, Josh, but I do think there's a few things. Certainly, investors have clarity now on the Middle East tensions. So investors that crave clarity, they now have it based on Iran, Israel, et cetera. It's tentative, but we're moving forward. I think there's four things that really have helped this. One you mentioned. There's been improvement on trade. The most threatened trade outcomes are improving. That's a good thing. Earnings are still growing. It looks like the economy will avoid recession. That's a second. Now you have two Fed officials talk about cutting rates, possibly as early as July. You're going to get some monetary stimulus. And finally, it's a huge week for the one big beautiful bill. And now President Trump has some momentum, perhaps some unity with the GOP coming off of a foreign policy victory that they can push this one big beautiful bill over the finish line. And that's fiscal stimulus, monetary stimulus, avoiding recession, improvement on trade, clarity on the Middle East. That's your rally, Josh.
Michael, let me ask you, you mentioned the Fed. Of course, Jay Powell was on Capitol Hill today before those lawmakers. Does the Fed need to cut, Michael, for this market to move higher? Because I've spoken to other strategists that posed that question, Michael, and they said no, it doesn't. Now, their argument was because what's driving the market here is not monetary policy. In their opinion, it was first and foremost tariffs, but curious to get your take.
So last time I was on, we chatted about this a little bit, and I believe that the Fed is behind the curve, and this could be one of the biggest threats to the rally. So two things, I think. One, I'm not sure tariffs are inflationary. Josh, auto tariffs of 25% have been in place since April 3rd. I can tell you this, auto prices are not going up. So I'm not bought into this idea that tariffs are automatically equal to inflation. If they're a tax, they reduce consumption. That can't be inflationary. The second thing is if the Fed is at 4.25, 4.5, and their preferred measure of inflation, which we get a new number on Friday, is at 2.5, they're pretty restrictive. They could cut rates 3 or 4 times and still be 1% above the current rate of inflation. So I do think that the Fed will need to cut as this economy slows and the labor market worsens later in the year for this rally to continue.
On tariffs, Michael, what do you say to those folks who say, listen, the pain is yet to come. It just isn't showing up in the data yet. You mentioned autos. They'll say, hey, listen, here's what's going on. People just went out and bought those cars ahead of the tariffs. But just you wait, they say. June, July, you're going to see it.
I think these are the same folks that believe that tariffs were inflationary back in 2018. The Fed was right there with them, alongside them, and that wasn't the result. Now, I get it. A lot's changed between now and then, but you can't describe tariffs as a tax and then tell me that they're inflationary. Those two things do not go together. So I just feel like, again, they ignore some of the offsets, some of the other things that are happening. The economy's cooling. I think the labor market will weaken. Oil prices are right back down into the 60s. Consumer confidence numbers, some of those soft data numbers are starting to show some challenges. So I think the fear of inflation is likely greater than the actual result. And for that, I think that was true in 2018. And I think it may be true again here in 2025. You
mentioned oil, Michael. I'm glad you brought that up because it is tumbling again today. I'm just looking at WTI. We're down another 6% here. You've been banged back down to 64 and change. How much is that a tailwind for the market? How much does that explain the green on my screen here with the popular averages?
I'm not sure it's the price of oil exactly, but I do think this is a proxy or barometer for tensions in the Middle East. And I do think that the greatest fears headed into this week, following some of that tension, some of the military actions there, was that oil would have a runaway price to 100. Now, obviously, we saw a bit of a spike. It did touch 80, and now it's back down into the 60s. This suggests to me that the demand for oil, the appetite for oil is kind of modest. And ultimately, again, this is a signal to me of a global economy that's growing, but not growing at a breakneck pace, which again is why I think that the Federal Reserve needs to be very careful here in terms of their next move.
So we talked the economy, we talked Fed, Michael. Let's add it up, give viewers some places to put their money to work. Where are the opportunities in your opinion?
So we continue to like technology. We understand that it's a bit pricey, a little bit of a momentum trade, but here's the thing. You got to go where the earnings growth is, and technology is where the earnings growth is. Now, we do prefer to move beyond the Mag 7. We think that companies that spend the most may not be those that end up benefiting the most. And oftentimes, Josh, we know in technology, it's all the companies that kind of glom onto that spending, find something to do a bit better, more efficient, a cooler product, a cheaper way to do it, that ultimately are the winners. So we like tech beyond the Mag 7, kind of a more equally weighted tech leaders exposure, high earnings growth, AI phenomenon. We still like that from that perspective. We also think financials will benefit given the fact that the economy is going to avoid recession. And with all this trading activity, we think that should boost some of the earnings of the Morgan Stanleys, the Goldmans, the JP Morgans, and the like. And you may even get some deals, M&A and IPO activity to tick up later in the year if we get some clarity on trade, M&A, monetary policy, fiscal policy, and the like.
Michael, always great to see you on this show. Thank you for joining us.
Josh, my pleasure. Good to see you.